Welcome to the Art of Money Podcast with Art McPherson.
And this is the Art of Money Podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. Luke McCarty is here this weekend, and we are happy to be joined by McPherson Financial Group in-house CPA Mark Bernard. How you doing this weekend?
I'm doing well. How about you, Mark?
Good. So this time of the year for you, Mark Bernard, and I know there's no off season for a CPA, but what does this time of the year, what does your desk look like? I mean, are you helping people file extensions? Are you starting to get some early returns in? What are you up to this week?
October 15th is if anybody extended on their individual tax returns, October 15th is the deadline. So I have a couple returns that we're getting out here at the last minute, but October 15th is a big deadline.
Artofmoneyradio.com to meet Mark Bernard and the entire team and also schedule that complimentary consultation. And gentlemen, it was this week back in 1973, Vice President Spiro Agnew resigned after pleading no contest to income tax evasion. And you often say that taxes can really make or break a good retirement plan. So, Mark, if you have a client who likes to use that DIY strategy, what advice would you offer them?
You know, I think the big thing about doing the DIY is that you miss opportunities to maybe reduce your taxable income. You know, charitable deductions, whether you should itemize versus standard deduction. Maybe there's some things, if you're doing a Schedule C, business income, with rental income on Schedule E, you might be missing deductions.
Just a couple of elements that you might be overlooking if you have that strategy. And there's nothing wrong if you're a DIY person, but it's also nice to have a CPA overlook your work to make sure that everything's okay. And again, that consultation, no cost, no obligation to you when you call 321-425-8550, always online at artofmoneyradio.com. And gentlemen, we were talking before we got started here about a new opportunity for investment properties, a 1031 exchange. Tell me a little bit more about that.
Yeah, so a 1031 is used when you exchange investment properties. You do a swap. So you trade in one investment property for another investment property. And if you're able to successfully use Section 1031 of the tax code, you can have capital gains deferred. So the sale of the first property does not create a taxable situation. You're actually swapping the two properties, and you move the basis of the first property into the basis of the second property, and then therefore not recognizing current capital gains.
Yeah, so if you think about it this way, right, if you have real estate property in the family and you want to keep it in the family, but you want to buy a different one, right, do the 1031 exchange so you don't pay taxes today, kick the can down the road with the end goal, right, this is going to sound morbid, but when you or your wife or you guys pass away, it can still go tax-free to the kids. Mm-hmm. So kind of kick the can as many times as you want to, and then your kids may get the step up in basis. You know, there's a lot of things that can go into it from a taxation and a legacy plan as well.
Yeah, so, and there's no limits on how many times you swap it. So if you keep wanting to continuously swap property to property, you can do that. There's no limit.
And if you don't, let's say you own rental properties and you're the landlord, right? So you want that income stream, but you're retired, so you don't want to deal with it anymore. Well, 1031 may not be right for you because then you're buying another property and doing the same thing. So there's other ways around that capital gain. One is called a DST, a Delaware Statutory Trust. Essentially, you pool your money and your gains together with others, and you buy into a big building, and you kick the can down the road, but you still get income from it. So there's a way to not pay the tax today, still get your income, and kick that tax can down the road.
Hey, you mentioned something there, Luke, a couple of seconds ago, a stepped-up basis. If we're just getting educated about our retirement strategies and our tax strategies, what is that?
So step up in basis is, when you pass away, your assets, when they go to the kids or your heirs, they inherit them at today's cost. So maybe you bought the house for $100,000 and now it's worth $500,000. Well, if you passed away today, your kids would get it at the value of $500,000. And so they could sell it for essentially no gain or keep it. And if it grows from $500,000 to $750,000, that could be what they're on the hook for. So it's a way to, inherit properties. It's really big, of course, in farmland or even businesses, or of course your primary residence is included in there.
So there's nothing wrong with asking questions. So if you hear anything on this weekend show, you just need a little more clarification on, give the team a call at 321-425-8550. No judgment zone because it's your money. Let's make sure we have the right strategy plan for you. 321-425-8550. Always online at artofmoneyradio.com. Joined here this weekend by McPherson Financial Group in-house CPA Mark Bernard. And Mark, at the beginning of the show, we were talking about small businesses and how they've really taken a hit during this economic downturn. What are some of the effects that they are feeling right now between these high interest rates and just because, of supply chain issues? What are you dealing with small businesses in the area?
What a lot of our clients are telling us is that the dollar is strong. So for people that are buying from China or Singapore or India, they're starting to see that they have a strong dollar. They're actually doing pretty well with the strong dollar.
The dollar is very strong right now because, the Federal Reserve is raising interest rates, and we're one of the only countries, with the ability to do that because our economy is so strong. So if you're traveling, to Europe, right, the dollar to the euros, at parity. Of course, it moves every day, but, that's kind of what Mark mentioned is if you're buying supplies from out of the country, it's actually cheaper for you because the value of our currency, the dollar, is a lot stronger than other currencies.
Was that another piece of a little bit of good news, Luke? I think that's 3 times in one weekend.
That can be some good news. However, some of our allies, and even NATO kind of reached out to the Fed and reached out to Powell and said, hey, you United States raising interest rates as you are, you're crushing our currency, which is hurting our economy. So we may start feeling more pressure from our allies to slow down the rate of which we're increasing interest rates because now everybody wants to own a U.S. Treasury paying 3%, where historically it's paid, the last several years it's only paid 1%. So there's a very strong dollar. Can be good if you're buying things overseas. Can be bad if you're overseas and you're our ally and, we're theoretically crushing your currency.
All right, I take it back. That's only 2 pieces of good news this weekend.
2 pieces.
Not
good
3.
and bad. The pros and the cons, right? That's what we tell you here. The both sides of the story.
Right. All right, 2.5 pieces this weekend. Hey, 321-425-8550, artofmoneyradio.com. And Mark Bernard, in-house CPA with the McPherson Financial Group. We mentioned it earlier in the show that our national debt is now $31 trillion. And we all agreed that means our taxes are going to be going up because somebody's got to pay for this eventually. So talk to me for a second about the importance of having that tax strategy now more than ever.
Yeah, so, we always talk about Roth conversions because President Trump put into place this tax rate schedule that is due to expire after the tax year 2026. And that's if we don't get another act of legislation before then. But we're pretty confident that with the way that the debt is and the way that Congress is spending and the country is spending, we would be really surprised if we go back to the old Bush-Obama rates, which, adds about 30% more taxes to your tax bill for the same income you earn today.
You mentioned Trump, Bush, Obama. We're in election year right now. Midterms coming up in a couple of weeks. Does an election year, does that really affect our bottom line when it comes to a tax strategy? Or now that we're in fall and the holidays are coming up, do the seasonal effects to taxes mean anything, or is that just nothing?
No, it does mean something to me because there's a lot of tax planning that needs to be done during the calendar year for your taxes. So, for example, a Roth conversion, if you're wanting to take advantage of a Roth conversion, you have to do that before December 31st, 2022.
Yeah, and let's be real, right? If you haven't done it yet and you're waiting for all your Thanksgiving and Christmas invitations and all your pictures and all your parties, you're probably not going to do it. So, now's a good time to look at it, especially with the market being depressed. You can move assets, at a lower value today, into the Roth. So, it's always good to have that plan. And, before the end of the year is when you need to make most of those decisions.
And then I'd also say that this year is a bit unique because we have this down market going on. There's a lot of capital losses that can actually be triggered in some of your investments. And triggering those losses can also then allow you to look at things that you have big built-in gains on and maybe use capital losses that you're triggering to offset other capital gains.
For example, if you have let's just call it a balanced fund, right? A mutual fund, a balanced fund from, you name the company, it's down about 20%. Well, if it's in a taxable account, a brokerage account, a joint account, a trust account, things that you're paying taxes on every year, you should think about selling it, capture that loss on paper, and then buy a different balanced fund, right? You just can't buy the same exact one, and every one of those managers does something different, so you can avoid the wash sale rule. Take a loss on paper for taxation, but stay invested. And that's what we're doing with all of our clients now is, even though some of the funds that we are in, because the market's down, you want to take advantage of it, because if you don't do anything and the market rebounds, you're in the same spot, just not for your taxes.
So we always talk about here on The Art of Money, that importance of having that tax strategy. 321-425-8550 to meet the team, to schedule that consultation. That includes a conversation with in-house CPA Mark Bernard of the McPherson Financial Group. And before we get out of here, Mark, one more time, you've said it before, every time we have you on the show, there is a difference between tax prep and tax planning.
So tax planning is looking at the various strategies to try to reduce as much taxes that you're going to have to pay. And we've talked about a couple strategies today. Tax preparation is gathering all your information after the year is over with. Turn it over to me or your other CPAs and have us put pen to paper.
Tax preparation is what I did in Dallas for 3 years at the CPA firm. And there was no time to do any planning because I was the prep man.
Well, it's the importance of having a strategy, and it's the importance of having knowledge of your tax strategy. And that initial consultation with the team of the McPherson Financial Group, no cost, no obligation to you. Let's start putting that plan together. 321-425-8550. One more time, 321-425-8550.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174. 725.
Today's show has been a work of art.